92%. That is the statistical probability that a professional fund manager will fail to beat a simple index fund over any 15-year period. Most people assume they need a complex strategy to win, but in the stock market, trying to beat the market is a loser's game. The real winners are those who realize they don't need to pick stocks. By the end of this video, you will have a complete system that ignores the noise and focuses on the evidence-based math of wealth. This is the simple path to a multi-million-dollar retirement. Building wealth does not require complex spreadsheets or watching CNBC. It requires exactly 3 funds, 1 brokerage account, and 20 minutes of your attention once per year. This is the system used by Nobel Prize-winning economists for their own money. While Wall Street tries to sell you expensive complexity, we are going to focus on the boring system that actually works. The reason for this failure is costs. Every trade an analyst's salary is paid for by your returns. A small fee can eat up to 25% of your total wealth over a 30-year career. Index funds have almost zero cost because they simply own the entire market. They don't try to be clever, and history shows that owning the market is the ultimate way to win long-term. Fund 1 is the total U.S. stock market. Whether you use VTI at Vanguard or FSKAX at Fidelity, you own a piece of every publicly traded company in America. From Apple to the smallest startups, you are betting on the collective ingenuity of the American economy. This engine of growth has historically returned around 10% annually. Instead of trying to find the next Amazon, you simply own them all. This gives you complete diversification across every sector of the U.S. economy in a single fund. Fund 2 is the total international stock market, VXUS or FTIHX. This gives you ownership in giants across Europe, Asia, and emerging markets beyond American borders. You gain ownership in companies like Samsung, Toyota, and Nestlé. It ensures your entire net worth isn't tied to the political or economic fate of a single country. Economies move in cycles. When the U.S. underperforms, international markets often lead. Owning both provides a smoother ride and captures growth across the entire planet. Fund 3 is the total bond market, BND, or FXNAX. This is your stabilizer. Bonds are essentially loans you make to governments and corporations for steady income. Bonds don't provide explosive growth, but they provide critical safety. When the stock market crashes, your bonds act as a parachute, holding their value or even rising. Having bonds gives you the emotional resolve to stay the course. It prevents the biggest mistake in investing, panic selling at the bottom when things feel uncertain. How much should you own? Subtract your age from 110. That number is the percentage of your portfolio that should be in stocks. The remainder goes into bonds. This simple formula ensures that you are aggressive when you're young and automatically shift to a defensive position as you age. It removes all the guesswork and emotional stress from your strategy. No more wondering if you're taking too much risk or missing out on growth. For a 30-year-old, the formula dictates 80% in stocks and 20% in bonds. At this stage, your goal is maximum long-term growth. Within that stock portion, we recommend 65% in the US and 15% in international. You have decades to recover from any market volatility. By age 35, your target becomes 75% stocks and 25% bonds. You are still growth-oriented, but starting to build a safety net. The formula gradually de-risks your portfolio. This incremental shift happens year after year, ensuring your risk profile always matches your time horizon. By age 40, your target is 70% stocks and 30% bonds. You now have more capital to protect, and stability becomes a higher priority. This 30% bond allocation provides a substantial cushion. It ensures you stay in the market during the bad times, so you are there for the good times. Once a year, you perform the only active step, rebalancing. If stocks have had a great year, they may now represent more than your target percentage. Rebalancing forces you to sell that extra 5% of stocks and buy more bonds. This simple act forces you to sell high and buy low automatically. It feels counterintuitive to sell what's doing well, but this is the secret weapon of the system. It takes 20 minutes once a year and resets your risk. Fidelity, Vanguard, and Schwab are the big three. All three offer zero minimum accounts, zero commission trades, and world-class index funds. Vanguard is user-owned, while Fidelity and Schwab offer sleek, modern interfaces. For the average millennial investor, they are all equally excellent choices. There is no best brokerage. The only wrong choice is waiting. Pick one today, open your account, and start your journey toward financial freedom. The true magic of this system is the automation. Set up an automatic monthly contribution on the first of every month and let the math do the work. This removes all emotion from your investing. You buy when the market is up, and more importantly, you buy even more when the market is down and stocks are on sale. The final step is to ignore the noise. Financial media is designed to keep you anxious, but the investors who do the least outperform everyone else. Success in investing isn't about intelligence, it's about temperament. If you can simply stay the course and rebalance annually, your success is nearly guaranteed. Follow this boring system and you will, with very high statistical probability, retire wealthier than the majority of Americans who tried to outsmart the market. You don't need to be lucky, and you don't need to be a genius. You just need to be disciplined. The research is done. The strategy is proven. Now, get started. Which brokerage are you leaning toward? Fidelity, Vanguard, or Schwab? Let me know in the comments below. Subscribe to Steady Wealth for more. Let's build wealth the steady way. Subscribe to join our community of evidence-based investors. We'll see you in the next video.